We go now to our Mozambique market update and Capranzine Hunguana, who is Global Markets Analyst at FNB in Mozambique. Let's just talk about the rise in inflation in Mozambique. We've been talking inflation in Kenya and Uganda earlier this morning and how the central banks there have really kept that inflation down.
Yes, indeed. Inflation saw a marginal increase in September. We don't have October's figures yet, but we still expect another very small increase. As you know, we are in the middle of a seasonal inflationary period in the country going towards the festive season. So it is absolutely normal to experience these marginal increases in inflation, and it should stabilize again in January. And consequently, the central bank has kept the reference interest rates unchanged in September, but we still expect another drop in interest rates during the current quarter, as there is still much room for the central bank to influence interest rates in the market.
What has the pattern been with interest rate activity? We in South Africa are accustomed to very conservative and small movements in that interest rate, sometimes half a basis point, even a quarter of a basis point. And ours have been static for some time. They're at their lowest, in fact, in more than 35 years. The US, of course, has promised that their interest rates will stay where they are until 2015. So what's the context from Mozambique? Are you accustomed to things staying the same, or are you accustomed to quite big jumps, down or up?
Well, over the past 8 years or so, we have become accustomed to having the central bank playing a very prudent monetary policy management and not making very large cuts or rises in the interest rate. So over the past 12 to 14 months, we've seen the central bank cutting rates by 600 basis points, and it's been at a very, very measured pace. Again, I said that they have been very, very prudent in approaching monetary policy. And their main target is to influence GDP growth in the country. Unfortunately, we haven't seen lending to the private sector responding by the same token as the drops in interest rates by the central bank. And this is mainly because even those commercial banks, they are sitting with a lot of cash. Currently, we are sitting with around 19 billion excess liquidity in the interbank market. Commercial banks are still not able to pass that cash into the economy. And this is because we are very, very limited in how much of depositors' money banks are allowed to lend to the private sector. And if we look at the top 6 to 8 banks, most of them, with one notable exception, are sitting with loan-to-deposit ratios of around 70%. And if these same banks start lending and these loans-to-deposit ratios reach 90%, then it becomes a problem in terms of non-performing loans in the economy. And the central bank certainly does not want that. And that actually takes me to the question of where are commercial banks going to place that excess liquidity if the central bank is not issuing as much treasury bills as they did in the past. So that would only leave the capital markets, and we haven't seen much developments there recently.
Okay, and the equity market at the moment, in the context of what you've been saying and the fall in the Metical against the US dollar, the equity market behavior that you've seen and you expect?
Well, there hasn't been much activity in the equity markets over the past 2 years. At the moment, we only have 3 stocks in the equity markets, in the stock exchange. And we don't foresee much activity in the equity markets going forward, at least for the next 1 to 2 years. The stock exchange is still very much dominated by treasury and government bonds that account for over 50% of the total market capitalization. And we have information that one of the medium-sized banks in the market are going to issue commercial paper to the tune of 500 million meds. This is one way of sucking up that excess liquidity in the market, but it's still not enough if we compare the 500 million to the current 19 billion rand Metical excess liquidity that we have. We definitely need more product innovation in our capital markets, and this is the way to go to make banks invest their excess liquidity. And not only banks, but also insurance companies and pension funds.